Okay, for our final capital gain video, we just want to cover some miscellaneous odds and ends of items that we haven't talked about. They're in the slides, so I really don't have too much to say. Slide 23 is where we're at. The death of a taxpayer, leave enter. There's a deemed acquisition, deemed sale. And those will take place at fair market value, and it'll all be treated the same it would be treated if there was an actual acquisition or sale. In terms of tax avoidance, which there's again, we've talked about some already, there's a lot of tax avoidance issues here. We talked in another lecture about the fact that if we have non-arm's length parties, any sale or gift or other transfer is at fair market value with appropriate gain recognition. Remember that the ACB to the buyer is what they pay. Well, actually, it's the amount paid or fair market value if the amount paid was too high. Okay. So it's the lesser of there to prevent, again, any manipulation or things of that nature. So we've talked about that. We've talked about the fact there would be attribution on income that would be connected with transfers with the non-arm's length party if there is a attribution, if there's a income factor connected with the property being transferred. Okay. Other tax avoidance things that show up is if we transfer depreciable property. If there's a terminal loss, the terminal loss will not transfer. The terminal loss will remain with the original owner. What they're basically doing here, it's in the slides, the rules. What's going on is they're saying, okay, a terminal loss represents, if you think about it, I don't think we actually necessarily talked about this in the CCA slides, but the terminal loss represents an amount used up that wasn't deducted. Remember, we've said that CCA or depreciation simply represents estimates of amounts used. So this is an amount used up, not necessarily deducted, all right? So what they're saying is the using happened with the original owner, not with the new owner. So the loss should stay with the original owner. And then when the property is actually sold outside the group, that's when the original owner will deduct the loss. All right. So you get things like that, that again, they're preventing a loss transfer, kind of a if you've got company one can't use the loss, company two can, let's transfer it over to company two. Well, company two is not who incurred the loss economically. So they're preventing that sort of activity. All right. We have another tax avoidance that can happen on a sale of land and building together. And of course, it's common that you would sell the land and building together, but sometimes the building doesn't have a lot of value, that the and what winds up happening then when we allocate the purchase price, you wind up with a capital gain on the land and a terminal loss on the building. Well, whoops, BLDG, there we go. The government doesn't like terminal losses because they're 100% deductible. Capital gain is only 50% taxable. So they adjust the price is what they wind up doing. And as a note in the slide, they adjust the price so that the capital gain goes down, and so does the terminal loss. They reallocate the price to prevent manipulation there. Okay. An ability to pay concept, again, this is not tax avoidance. This is back to being fair. Sometimes property is destroyed or sold or traded in, but then replaced. And if it's things like buildings, it can take a long time. There's a timing issue because it can take as much as like 2 years to replace a building. All right. And like you might rent for a while and so forth. So again, our ability to pay concept, our fairness idea says, well, that pooling concept now isn't going to work because we didn't actually purchase the new building or the new asset purchase is not in the same year as the sale. So we have a problem with the averaging out, and we wind up with the gain being recognized or the recapture being recognized or something of that nature when it wouldn't otherwise be recognized. So partly depends on whether it's voluntary or involuntary, but that's mostly a timing issue. Basically, if you replace within a reasonable length of time, then essentially you can get the benefit, what amounts to the benefit of the pooling. All right. The property gets put in the pool and the potential income gets deferred on these transactions. Okay, so there's a number of odds and ends of rules with capital gains, and as you might guess, a lot of this much more complex than we're saying or covering in this particular course. But you'll, as you go through, recognize issues, call the tax people, or you become a tax person and you deal with some of the more refined elements of the capital gains yourself.